Adam Johnson, taking a look at options trends today. Well, we continue along with our options theme, but now we take a look at the fixed income market and playing the Treasury market. Well, today we talked about that $32 billion auction of three-year notes is the first of the government's three sales this week. And with more supply coming online and the U.S. pushing up against that debt limit, some are, of course, saying that Treasuries will soon become a losing trade. A lot of Treasury bears are out there, some famous ones as well. Well, here to give us his trade is Julian. He's the CFO and senior market strategist at OpVest Wealth Management. He joins us from the NYMEX with today's options update. And Andre, this is an interesting trade. I mean, we've heard a lot about Bill Gross being bearish on Treasuries for quite a while, but today is one of those days when we actually see Treasuries trading off, yields rising. So tell us what the trade is.
Well, I think that right today you have that reaction where the treasuries are rising. There's a big flight to quality right now, but I think in the next couple months that they're going to actually peel off, especially with this debt ceiling we're coming up against. I think either way, if they raise the debt ceiling, there's really no one to buy our additional debt. The Fed's not buying our debt. China's not buying our debt. Japan's buying their own debt. And Europe can't buy our debt. So I think that you're going to see that sell-off in the treasuries. If they don't raise the debt ceiling, I think the treasuries are going to collapse. So basically what we're doing is we're looking at the ETF, TBT. It's a double short ETF in the treasury market. And as yields go up, treasuries come down, you profit on the TBT. But rather than just buying the ETF, we're just going to sell a put option. We're going to sell a put option. Currently, TBT is trading around $32.20. If you sell the 32 put out to September, you're collecting about $1.40. And if that expires above $32, then you get to keep that $1.40, which means you made about 4.6% on your investment risk. But worst comes to worst, let's say the market does come down and you get assigned, or it expires below 32 and you get assigned. Well, remember, you still get to keep that $1.40, and then you take that less the $32, which is the strike price. You're looking at a break-even point of about $30.60 per share, and you own 100 shares of this ETF. At that point, you can decide what you want to do. If you're at a profit, great, you can always take it. If you're a bit of a loss, you can take that, or you can hold it. If you really think the treasuries are going to start to sell off, it's great to own that ETF as well. So you can capitalize on collection with the option selling, and then you can capitalize on the actual ETF if you end up owning it. So I think it's a winner either way.
Quickly, Andre, so the leverage in the ETF is 2 to 1, right? Negative 2 to 1 correlation with Treasury prices. With the actual put option, what does your leverage turn out to be when Treasury prices fall?
Yeah, it'll really be the same if you look at it, because remember, our goal is to get assigned this. So you're still looking at a 2 to 1 leverage, so it will work against you, but you're still limiting your risk on the downside because your risk is limited to the difference between the strike price and the amount you sell it for anyway. So you do have to be willing, and I think that if you're going to use this kind of a strategy, you're going to have to be willing to own that underlying ETF or stock. Otherwise, it's too risky of a strategy for you because there is that extra leverage created.
All right. Thanks so much, Andre.
Thank
Interesting
you.
Look at a trade. The ticker, by the way, on that ETF is TBT. It's a bearish Treasury ETF. That was Julian, CFO and senior market strategist at OpVest Wealth Management. Okay, coming up.